forcing hedge fund Archegos to sell more than $20 billion worth of stock last week. Despite what could become one of the largest liquidations of all time, there does not appear to be much market reaction to this. This was not the case back in 1998 when hedge fund Long-Term Capital collapsed, forcing a bailout by the Fed, and 14 financial institutions were involved. So what's the same and what's different now? Jim Rickards was the general counsel for Long-Term Capital back in 1998. He's also the author of a current Wall Street Journal bestseller, The New Great Depression, Post-Pandemic Winners and Losers. Jim Rickards joins us now. Jim, thank you so much for being here with us. You had a very, very big and very front row seat view to what happened at Long-Term Capital. Take us through what exactly you see similarly and different about Archegos versus Long-Term today and then.
Sure, Dominic. Great to be with you. Yeah, there are a lot of similarities, and it's kind of I don't know if it's scary or humorous, but LTCM was 22 years ago. There were definite mistakes made. They were identified at the time. Everyone said we have to fix this. They were never fixed. Here we are in 2021 with the same scenario playing out again. We'll see if there's more contagion. But, at the time, the criticisms of LGCM were obvious. It was over-leveraged, non-transparent. And in particular, everyone knew we were a fixed income arbitrage firm. Very few people realized we were the largest risk arbitrage firm. We had enormous multi-billion-dollar positions in stocks. And that's what really kind of freaked out the Fed and Wall Street. But we did it all through derivative form, basket swaps, equity swaps, and so forth. We kept it to 4.9%, but none of that was publicly disclosed. Now, Archegos is the same thing, except they blew through the 5%. And that's, it's a little bit of a gray area legally, but I'll leave that to the lawyers. But they were up to 10% in some of these positions. But they never had to report it because it was in derivative form. But in 1998, Brooksley Bourne, who was the head of the CFTC, said, you really ought to, to the SEC, you really ought to change the rules and require some reporting or transparency on that. She was squashed by, the Boys Club, Bob Rubin, Larry Summers, and Alan Greenspan, and nothing ever happened. So someone said to me the other day in Archegos, gee, why don't, we really ought to change the rules so they report this. I said, well, they said that 22 years ago, and it never happened.
So, Jim, let me get this straight here. I mean, we know that derivatives have been a huge focus of this. The opacity, the lack of transparency, the way that if I look at the holders of a certain stock, sometimes it just says maybe a name hypothetically like Goldman Sachs or Morgan Stanley, but that they're doing it with regard to derivative transactions with clients of theirs, but they're the ones who are owners of record. Now I get all of that. Why is it then that we are not seeing as much of the contagion type effect right now that we did see with Long-Term Capital? I mean, global markets were roiled because of what will be, even inflation adjusted, a far less of an amount for Long-Term Capital's eventual bailout than what's going to happen with Archegos.
Well, that's right. But remember, the LTCM bailout, the rescue money, was about $4 billion. That's a lot of cash to come up with in a few days. But the book was $1.4 trillion. So the notional value of the book that LTCM had, and of course, all the counterparty risk, because there were banks on the other side of all those trades, that was $1.4 trillion. And that was really what concerned markets. If we had not pulled off that rescue, global markets would have just shut down around the world, at least for a while. That's how bad it was. But here's the thing, Dominic. The LTCM came to a head in August, September 1998. But it actually started in July 1997 when Thailand devalued the baht. That was their currency. They were pegged to the dollar. They broke the peg. That started a capital flight out of Asia, went to Indonesia, Korea. There was contagion. Then it calmed down a little bit. Then eventually Russia, and then back to LTCM. Come forward to 2008. Everyone remembers September 15, 2008, the Lehman Brothers collapse, and AIG after that. I mean, Morgan Stanley was hanging by a thread. But that actually started in late July 1997 when those two Bear Stearns hedge funds collapsed. Bear Stearns itself collapsed the following year. But they shut down those two hedge funds, and there was the famous Jim Cramer, they know nothing, and Cramer was right about that. My point is, in both cases, it took over a year to come to a head. So hopefully this thing is contained. That would be the best result, but it's way too soon to say that there won't be contagion here, because sometimes it could take a year.
So, Jim,
Shepard Smith here. Thanks for watching CNBC on YouTube.